Good morning, everybody. It's Mike Kasselneck. Thanks for being on the call this morning. And as usual, this is our time to share any ideas and things going well, things going poorly. This is a fantastic time for you guys to bring those sorts of things up, because if you have a question or a concern or a victory or a defeat, everybody on the call can benefit from that. So we have a guest speaker on the call today. I've got one thing I want to cover before we get to Jason. But this is, again, your time to ask questions, etc. So, Missy, do we have anybody with their hands raised want to ask a question, make a comment, etc.?
I don't see any hands, and there's no typed-in questions either.
Okay, super. Well, the first thing I want to cover, if we can see a show of hands, has anybody seen the article, I believe it was in Insurance Newsnet, about the advisor out in California that's getting prosecuted for selling an annuity? Has anybody seen that? Can I see a show of hands? And Missy, I can't see the hands. I'm sorry.
Yep, I've got quite a few hands that are popping up here.
Okay, super. So here's the thing. First of all, the case they have is bogus. But I had a long discussion with Jason on Friday on this, and the fact is that I'm telling you, he does not deserve what he got, but he could have totally avoided the situation he got himself into. So it's like your kid walking down the street wearing his pants down, and he's wearing a bandana, and he's looking like a gangster, and he gets beat up, and then you say, well, what the hell were you doing in that neighborhood for? What the hell were you dressed like that for? What the hell were you doing? He didn't do anything to deserve the beating, but after you make sure he's okay, you're going to say, what the hell were you thinking? So here's the thing. We live in an environment where if you sell products, you're going to have problems. If you go in and sell a product and that's the only thing you do, you're going to have a problem. So do you know what I mean by selling a product? I mean, somebody comes in and says, I want one of these things, and you sell it to them, and they walk out the door. That is a problem. The one thing that our system will do is prevent these kinds of problems. First of all, who do we market to? 55 or 60, at 55 lowest, 60 60 or 60 for the lowest, either one, depending on your territory, what you're after, all the way up to 75. Why do we stop at 75? So, Jeff, why do we stop at 75?
Well, there's just, you just run into problems with people that are older than that. It's just, a natural aging thing.
Well, and the thing is if you sell somebody something to somebody who's 80 or 85, anywhere in that age group, guess what they're going to immediately assume? They're going to assume exactly what California assumed, which is what? You're screwing the client. But these poor people can't think for themselves. In this particular case, she couldn't because she was in stages of Alzheimer's. But the fact is, even if they're lucid and sharp as a tack, if it's that old, you lose. You're guilty before proven innocent. So first of all, we only go between ages 55, 60, and 75. But here's the big thing that we do. Use the system. Jeff, we've had lots of conversations in the past decade with guys that call us, and they say, hey, I didn't even need to use the system. They walked into my office, and they had $150,000, and they just wanted to move the money. And what happens?
Yeah, there's a look back, or there's a problem, or, all kinds of things can come up. I mean,
guys,
you don't know.
You don't. We don't sell products. We go through a process. Do we sell anything at the first meeting? No. All we get the commitment is to move. And we're having a conversation between me and the client. At the second meeting, we're going through 18 to 21 different issues. And do I tell them any of the issues? No. They tell me. So, Jeff, if there's a couple there, do I only talk to one person in the couple?
No, you're going to talk to both.
Why do I have to talk to both?
Because you need to make sure both are on board and both understand.
Yeah, because if both aren't on board, what's going to happen when they leave my office?
Yeah, somebody's going to change their mind.
Yeah.
Somebody's going to talk the other one out of it.
Yes, exactly. So if this guy had a conversation about survivor's guides, had a conversation about powers of attorney, had a conversation about medical directives, had a conversation about umbrella liability insurance, had a conversation about all those things, and remember, at the second meeting, we tell the client nothing. The client has to tell us. Tell me, would he have been able to identify that this woman had Alzheimer's? I have a family member who has Alzheimer's. And I've seen it from the early stages all the way up to a stage where they don't know they barely know what's going on right now. So the fact is even in the early stages, you could see the stumbling and not following and not being able to track what was going on. This guy would have, if he had a process where he wasn't just selling a product, he would have been able to identify her as a person who was not lucid or being able to make a decision. The second thing is, if when the regulators came in, he showed them that, listen, we got the survivor's guide in place. We got the powers of attorney properly done. We got the medical directives done. We got the da-da-da-da, and showed them all these different things he was doing. Guess what he would not have looked like? Somebody who was screwing a client for their money. So guys, our process is set up to avoid these kinds of problems. And I didn't set it up specifically to avoid these types of problems. I set it up this way because it's a much more profitable way to sell, because you will get tons of money by doing all these extra things. But in the bonus is you avoid these types of problems. And I will tell you, that, and Jeff, you can validate this, our guys that are audited by the states, because the states are required to audit the offices for a lot of RIAs, etc., for all our RIAs, and etc., when they come in, the auditors are in and out of our guys' offices lickety-split. Guess why? Because they go to every single, they say, draw these 5 random names, pull their folders. They pull their folders. Guess what they see in their folders? They see that every single client was treated the same. They see that every single client had gone through all these additional issues. They see that it's clean. And Jeff, am I talking turkey here? Am I full of BS?
No, that's absolutely right.
So why do the auditors love our guys?
Well, they just want to know that you're following a system, that you have a way of catching mistakes and not letting anything go through the cracks. And when they see that you not only have a system, but you're following it, makes everybody a lot more comfortable.
And when they pull 5 folders and all 5 clients are treated the same, what do they know about every single other folder in your filing cabinet?
There's a high likelihood that they're all the same.
And that makes them happy. So guys, don't ever sell a product. Go through the system. This guy would have, first of all, caught the fact that she wasn't lucid, and second of all, even if he hadn't, which he would have saved himself huge amounts of problems, because he had done a full-blown service for her instead of just taking her money and popping it into a high-commission product. Okay? So use the system. You're not going to run into these kinds of problems. The system is it's not designed to avoid these kind of problems. It's designed to sell a lot, and it does. But as a bonus, it prevents these kinds of problems. Do not, if Jeff or I ever catch you selling a product, we're going to give you a tongue lashing, because first of all, it's not going to hold, because they're going to say, oh, this is a great product, oh, thanks a lot. And then it's going to, 9 times out of 10, they're going to change their mind on you. But when you go through the process, they don't change their mind. We have less than a 1% buyer's remorse when they go through the process. So I wanted to cover that, because I know that everybody's getting freaked out about that, and everybody except the people on the 5Q system should be freaked out about it. We don't have to freak out about it because of the way we conduct ourselves. So any questions on that, Missy, as I was going through this?
Nope, not a question came in.
Super. Okay. Then what we have is Jason. Sorry.
I'm sorry, I spoke just 1 minute too soon here. One just came in. What about the home office? What's their responsibility?
Well, Jason, that's a better question for you than me.
Well, I mean, when you look at the home office, what they're going to look at is suitability. So more carriers, or some carriers, I should say, are doing more from a home office perspective than others. Allianz being, the case with Glenn Neesham in this particular example was an Allianz policy sold. You would think that it does go through their suitability process. Do they take any responsibility? I don't know that they do. But what you're going to see is a continuation of the big suitability standards that Allianz has. American Equity now has really ramped up their suitability. So you're going to see a lot of these carriers probably go even further with suitability. And really what we used to learn, I used to be a home office employee, is I used to say documentation, documentation, documentation. And 2 points that I want to make quickly off of this story. One is I knew Glenn. He's not a bad guy. He's not an evil guy. He's just like one of us. He's not a rogue agent, a commission guy. He's not. He's just a typical index annuity in a tough state. California is a really tough state. Allianz and California have never really seemed to get along, so there's a lot of probably politics behind there. Second point is I love Mike's point about selling a product because, guys, if you look back the last 2, 3, 4 years, what have products always done? They've improved. They've gotten better. So if you're selling a product and the guy down the street is also selling a product, if he has something that resonates with that client better, if you're just selling a product, they're going to go with that guy down the street just because his cap is higher or his this is higher. So you want to stick to what Mike is teaching with the system because that kind of eliminates the need for competing just based on product. But
And can
those
I
are my
jump in
2
here
points.
quickly?
Yeah, absolutely.
You know, one of the things I think that the caller is asking is, well, doesn't the home office have some responsibility here? And one of the things, I think the reason that this case is so frightening is one of the things the defense tried to say is, well, look, this is a product that the state of California has approved.
Proves, sure.
And this is a product that the state of California has approved for 85-year-olds. And this is a product that went through the suitability standards of the home office. So the moral of the story, and I think the thing that's frightening is, ultimately, the state doesn't have any responsibility. And ultimately, home office doesn't have any responsibility. It's whose
Doesn't either,
responsibility to look out for who? It's your responsibility to look out for yourself.
Absolutely.
You can't say, well, it was an approved product in my state, an approved age, so I guess I'm scot-free. No, it doesn't work that way. Or it went through the suitability standards of home office, so I guess I'm not going to have a problem. No, it doesn't work that way. You need to have a system in place at your level, at the retail level, when you're meeting with clients, because ultimately you're responsible for everything that happens to your clients. So make sure you have a system in place to protect yourself, because no one else is going to look out for you.
Well,
Not
guys,
the compliance department,
guys-
not the state,
But
the
I'm-
home office.
Not
I'm,
the carrier.
and you know, and I don't give a rat's ass what Jason just said about the guy being a nice guy. You know what? It was his responsibility. There's a lot of frickin' surgeons that get sued even though they're nice guys because they did malpractice.
Absolutely. Absolutely.
I don't give a rat's ass if he's a nice guy. If he would have done the system and he was talking to both people, it was her frickin' money, so obviously he wasn't even talking to the lady's mom who had the money. He was talking to the boyfriend who wasn't even her money, or his money. And if he would have had a conversation with her and had her explain back, and guys, you never can sell anything unless the client can explain back to you exactly what they're buying. Because and this is for a sane person or a person with Alzheimer's or whatever, it doesn't matter. Because here's the thing, even with a person who's perfectly lucid, perfectly intelligent, they have to explain back what they bought, and this is what we train you on the system. Here's why. Can we assume that after they buy it, they're going to find somebody, when they find out they bought it, that's going to tell them it was a bad idea? Maybe a neighbor, maybe a friend, maybe a son, maybe a daughter's going to say, oh, what did you just do? You're crazy. And then what do? Oh, my gosh, you're right. The easiest thing to do is just stop the whole thing. You have to make sure that the client is buying something, knows what they're buying, and they know, and you have to go through all of the common objections to that product and make sure the client can explain why it doesn't apply to those objections. And again, we train you how to do that, so that when the neighbor says, oh, that thing doesn't have any liquidity, the person who's buying it will say, what do you mean it doesn't have a liquidity? What do you have? Do you have mutual? What do you have for investments? Well, I have mutual funds. Well, this is way more liquid than mutual funds. They'll argue back. Remember we talked about that with the cognitive biases, the CIA call that we had? They'll argue back to the neighbor. They have to leave fully armed with what how the product works and all the common objections to it. If this guy had done that, do you think that he would have figured out that she wasn't fully lucid? She was 4 years into Alzheimer's because she was now he didn't know this, but she was diagnosed in 2002, so she was almost 7. Or what? I guess it's all happened a few years back. So she's about 4 or 5 years already into the stages of Alzheimer's. Now he didn't know that, but would he have known that if he tried to have her answer all of these questions? Yes. That's why you don't have to worry about at least this particular scenario, because you're not going to get into that situation. So Jeff's right. It is your responsibility. And Jason's right. He is a nice guy, but that gets you diddly squat. That's why you have to have a system in place. Auditors, regulators love our system because it covers everything from front to back. And you don't have buyer's remorse because the people are explaining these things to you, and you're going to catch these kinds of problems. Okay? So use the system. Do not go in. I don't care how easy you think it is to sell. Somebody comes in with $100,000 says, I just want this particular product. Do not do it. Take them through the entire system. You're avoiding, I could spend the whole hour on all the problems you're avoiding by taking them through the system instead of just selling a product. Okay? So any other questions come in while I was ranting and raving?
Nope. No
Okay.
other questions.
Okay. So we have Jason on because a lot of guys are confused about why you'd want to do a fixed index annuity versus a VA, or a VA versus a fixed index annuity. So I thought I'd go right to the source and have Jason kind of go through his viewpoint on why fixed annuities, or why and where fixed annuities make sense over variable annuities. Okay. Thanks, Jason.
All right, Mike. Thanks, guys. I appreciate it. Again, everyone, good morning. I appreciate the time that Mike, Jeff, and Misty have given me. We'll definitely have some time at the end for Q&A. So if you do me a favor, save those till the end, and we can address those then. As Mike said, it's been this is a timely topic. I've spent a lot of time with a variety of 5Q reps on not only why would I sell a fixed index annuity versus a variable annuity. I've even gotten into a little bit further with guys trying to overcome a variable annuity with a fixed index annuity. So obviously I come from the viewpoint of an FIA wholesaler, so I make my living off of fixed index annuity, so I always like to preface, you know, I'm obviously biased. Are there places within the client's portfolio for both a fixed annuity, fixed index annuity, and a variable annuity? Of course there is. What I aim to do this morning is aim you with hopefully some information on how the fixed index annuity can specifically overcome the variable annuity when you're running into that within your particular environment. So we are going to keep it product-based. I'm going to kind of go at it as a variable annuity, as a philosophy, as a whole. So I'm not going to dive particularly into each VA product, like let's say the Jackson or the Prudential Highest Daily 5. We're not going to necessarily get into those specifics. But if you do have questions either at the end or if you want to schedule a call with me, we can go over those particular VA contracts and how you can overcome those. So we'll get started this morning. Here are the topics. I'm going to kind of go an overview over the marketplace. Again, we're not going to dive into product specifics per se, but more keep it as a general, generic VA overview. How do FIAs compare to VAs? How to present FIAs, again, as an investment philosophy versus VAs. Yeah, it's always hard or tough when you're getting into bonus versus bonus or roll-up versus roll-up. You want to present FIAs as a philosophy versus the VA. And then finally, we're going to open up for Q&A. So what I did initially is just define, according to Investmentpedia, what a variable annuity is. It's an insurance contract. At the end of the accumulation stage, the insurance company guarantees a minimum payment. The remaining income payments can vary depending upon the performance of the managed portfolio. And what you're going to see is, you know, I'm not sure the audience or what the experience level is with the audience with VAs, but what you're going to see, the big thing on VAs is upside potential. So when you look at that, how it particularly compares to FIAs, a lot of reps out there really go after the VAs with growth, growth, growth. And what you're going to see is these insurance carriers have had to adjust not only the pricing of the product, but the level of growth that they can provide within each one of these managed accounts. So you're going to see how that changes. The portfolio generally invests in equity securities, and its performance determines the amount of this total payment. Often have guaranteed minimum lifetime benefits. That's what the GMLB is. And GMDB, that's your guaranteed minimum death benefit. Those are two strong features of the VA that we'll get into later. Performance, again, is based on the sub-accounts. That's going to be the biggest difference between a VA and an FIA. Obviously, the FIA is tied to some kind of index, whether it's the S&P, NASDAQ, or what have you, where the VA actually ties to a particular sub-account that can be a variety of different things. So, like I mentioned, the GMLB and the GMDB, these are big benefits of the VA. If you guys are selling FIAs or VAs, you're probably already obviously familiar with these. But the guaranteed living benefit offers a guaranteed quote-unquote roll-up of anywhere from 4 to 8%. Now that can be simple, that can be compounding. That's going to be the big difference between the competitiveness of the product. The GMLB value pays to the policyholder for a lifetime. The guaranteed death benefit, these are something that when VAs first came out made them extremely strong. You've seen a lot of these death benefit values kind of decrease, yet the in-force VA contracts that you're going to run into, this is a big, big feature when you're comparing whether it's a replacement or something along those lines. You're always going to want to know what this guaranteed death benefit value is. That usually goes to policyholders' beneficiaries at death. Continuing on, this is a big piece of what they invest in. So the next two features of the VA, if you think about it on the T-chart, right, when you're looking at whether it's a VA or an FIA, you're going to have a left side of the equation and a right side of the equation. The left side is generally your sub-accounts or your buckets or your accumulation value, whatever you want to call it. This is what they usually invest in on that left side of the column. On the right side of the T-chart, you've got your income account, which I mentioned earlier, which is your guaranteed living benefit. Yeah.
Jason, I don't see a T-chart. Are you just talking figuratively about a T-chart, or are we supposed
figuratively.
Okay.
No, I'm talking figuratively. So if you think about it, if you've got a pencil and paper handy, you could draw the T-chart.
Okay.
And again, generally speaking, with a VA and an FIA, they're going to offer both of these values. On the left side, you're going to have an account value, which is generally a walk-away account after your CDSC period or your surrender charge period. And then on the right side of the T-chart, that's your income account. That's where they're going to, or your GMLB. That's where they're going to credit that 4 to 8% that ties to a lifetime income. But over on the left side, on your account value, is really, guys, where I want to teach it is the opportunity. Because when you think generally about a VA, that left side of the equation is really what's going to make people excited. Because that's the side that has the upside, has the hey, we're going to make you rich type of potential, because that's where your money is particularly allocated in these sub-accounts. So when somebody looks at an FIA and sees a cap of 3%, oh, that's terrible. I can show you a variable annuity, which is going to give you much more upside than that 3% might on an FIA. Okay? Well, there's two ways, generally speaking, that inside of those VAs is how they allocate on that left side. The first one is target date investing. Okay, so this is going to be a 60-year-old or whatever, you name the age, and it's going to guarantee that your retirement date is, let's say, 70. So what it's going to do is it's going to guarantee a double of your money. Some used to even do a triple of your money the longer your target date was, but it locks in your allocation from day one. So day one, today, you open up the VA, you're going to be the most aggressive that you will ever be within that contract. So you're going to notice on point number 2, it's going to start at 85% aggressive and 15% fixed. That's day one of target date investing. And as you go through, let's say, again, you're 60 today, your target date for withdrawing these funds, let's say, is 70. The closer you get to 70, if that number that's 85 aggressive and 15% fixed, that's going to flip-flop by the time you're age 70. You're going to be 15% aggressive and 85% fixed. So that's going to be stuck in gold. You're not going to be able to adjust a lot of that, again, depending on the product, if you choose a target date investing approach. And again, the allocation can range from a small cap growth fund or like a more aggressive into just a straight fixed account. Okay, the gains lock in anywhere from daily, that's the Prudential product, the highest daily 5, or it can gains lock in annually, and a lot of opportunities in between. A lot of them do quarterly. Some of them even do like monthly or weekly. So that's target date investing, and what we've seen is a big change from 2-3 years ago when carriers had to kind of adjust their pricing. Is how aggressive can you go within that 85%? Allianz is a good example. They used to have all kinds of different funds available, small cap, large cap, international funds, a lot of these things. With what happened in '08, they wanted to keep their VA portfolio, but they had to draw back tremendously the aggressiveness that a client can allocate those funds. And we've seen that across the board. So a lot of them, the most aggressive you can do is, let's say, a blue chip dividend-paying fund. So you can't get into a Castlenick, Labarge growth fund. So a lot of these carriers, to minimize the upside that they have to price for, obviously, is they've kind of really drawn back on the aggressiveness that the client can take within their allocation. So if that spurs any questions, that's a big point, you guys, because, again, a lot of people sell VAs on the opportunity of growth, growth, growth. Why would you sell an FIA and get a cap of 3% when I can get you into a variable annuity with a living benefit that the upside is the sky? And that just isn't the point. That just isn't the case anymore, because your allocation options on the growth side have been reined in. So
and then you also have to account for all the fees. So even if the market average, because I think the days of people thinking the market's going to average 12% are over. I think people are more likely to assume it's going to be average of 6 or 7 based on what it's been going, what's been happening in the last decade. So when you take a 6 or 7, and then as Jeff went through last week, and we looked at the average fees for a VA, when you add all the different fees up, you're talking about 3 or 4%. So now you're looking at 6 or 7% minus 3 or 4%. You're down to the cap anyways.
Yeah, absolutely, Mike. And thanks for noticing that, because that's the big piece. Normally, when guys call in and say, "God, I'm up against the VHS, and tell me what I need to tell me what I need to say to overcome this," first thing is always fees. First thing is always fees. You've got your administrative fees, and you have your M&E fees. Those are generally on every single case, and that's something that should go without saying. I go into the fees a little bit later, but Mike gets the point exactly, because if you're thinking that it's a 12%, that's it's probably unrealistic. But if it's down more to 7 or 8% annual return, when you have a fee of 4, 8 minus 4 is 4. You're right where we're at, and that's in the up years. That doesn't even take into account the downside that the VAs inherently have in them.
Because remember, I'm just going to jump in there. Even in the down years, so if if you're down 4%, well, now you're down 8% because you're down the 4 from the market and the 4 from the fees. Yeah.
Absolutely. So the second piece to target date investing is obviously the income protection. So a lot of these products, obviously, this goes beyond even your GMLB. So within your GMLB, they credit annually, quarterly. Some of them, again, are daily, and this is going to anywhere from 4 to 8%. So a lot of these carriers kind of keep it, their roll-ups, if you will, in between these two numbers. But this on that side of the equation, on the right side of the T-chart, is going to be a lifetime income. So target date investing is a big piece of what VAs allow you to allocate to. The income protection is the other big piece where they tie your returns to a lifetime income. All right? So I did put some carriers on here, obviously, so you can take a look. AXA, Lincoln, MetLife. Prudential's a big one with their highest daily 5. I run into that a lot. Used to be the highest daily like 7, so it's really drawn back down to 5. MetLife's the big one. Jackson's a major player. Lincoln is too. Lincoln's got a really cool feature called their Eye for Life. If you run into Lincoln in the Eye for Life, give me a call. We can run through that. It is strong at first glance, but when you take a look at the fees, Mike mentioned 4% is a average fee. That's about right. When you look at the Lincoln Eye for Life, that can be upwards of 6 to 8% fee. It's when you add everything on top of the total fee structure. Not only do you have
Hello?
Uh-oh.
Jason, I think we lost you.
you're an insurance
Oh, there he is. Jason?
actuary, in your sub-account,
Hey, Jason.
talk crazy. Everybody's using your GMLB because it's such
Hey, Jason? Hold on one second.
Sorry about this, guys. Hey, Missy, why don't you call the office and try to get a hold of him?
Yep, I sure will.
Okay.
benefit.
Can you mute him while we're doing that?
Yep, sure can.
Okay. So, Jeff, can you hop in here and help out since you do help the guys with the VAs and analyzing them? Put you on the spot here.
Yeah, and the first thing that I would point out, because I know there are probably some guys that are familiar with VAs, that the things that Jason's talking about pertain to the guaranteed lifetime benefit riders. So you'll see three types of riders three types of living benefits when you run into a VA. The first one is the guaranteed minimum income benefits. You don't see those a lot unless you run into a client that's had it for a while. And those are where they won't guarantee the growth rate. They'll just say that at the end, well, they will guarantee the growth rate, I apologize. With the guaranteed minimum income benefit riders, they will guarantee a growth rate. They'll say that you get 7% or whatever the market does, whichever is higher. The drawback to those is you have to annuitize the contract. So we can talk about, how you attack that, but that's the guaranteed minimum income benefit riders. Those you don't see those anymore because people aren't excited about annuitization. And
Right.
the companies know that. So that when they know that you're going to be looking at annuitizing, that's a big turnoff for most people. So they went to guaranteed withdrawal benefits. And there they don't guarantee the growth rate, but they will guarantee what you can withdraw. They'll guarantee that you can draw 5% of the account value. Even you can withdraw your entire premium and step-ups plus step-ups no matter what. So you're always guaranteed to at least get back what you invested plus some growth, some step-up, as long as you stick to their withdrawal benefit. When Jason talks about they limit the upside potential and they mess with the allocation, he's talking about lifetime benefit riders. So those guaranteed withdrawal benefit riders don't guarantee income for life. If you can take 5% of the account value, then I guess that you can take it for 20 years. 5% times 20 years is you get back 100% of your money. But in year 21, they're done with the guarantee. They gave you back all of your money plus the step-ups that they promised. So the income ends. With the lifetime benefit riders, income is for life. But the drawback to those, like Jason was explaining, is they limit the allocation. They don't let you invest however you want.
Correct.
Because they're on the hook for that growth. So just keep that in mind. You'll see all three in your practice, and you'll have to be conversant with all three. But not all three limit your allocation, but the lifetime benefit riders will always limit your allocation.
Correct. Can you guys hear me?
Yeah, we sure can.
Oh, okay, cool. So, and to continue that point, what we've even seen further, Jeff, is a decrease in, or I don't know if decrease is the right word, but a limitation on the aggressiveness. And guys, depending upon the carrier, it's gotten really bad. Like Allianz, again, I hate to pick on Allianz on the VA side, but they went to the most aggressive that you could allocate to are bond funds. So that's the most aggressive that within those sub-accounts that you could allocate to were bonds. So you've seen them, and they've kind of come back a little bit in recent years to open up a little bit more allocation, but directly after 08, it was just bonds. It was strictly bonds is all you could allocate to. So we've seen a lot of drawback there, and to be fair, FIAs, we've seen a little bit there as well, but really on the VAs, because the story there is a lot of times is growth. So you've seen a lot of drawback on that side. To kind of sum it up, I put a little summary page, if you will, on this one. Over on the left side is VAs. On the right side, I put some FIA information. On VAs, the positive features around variable annuities is, again, the upside potential. That's really the sell. That's really the marketing of a VA, is alongside with the strong guarantees on the income and the death benefit or the withdrawal side. You do get upside potential inherently more than you would on an FIA. Again, that's the sell, that's the sizzle. More recognizable company names, can't get around that. Most people are familiar with MetLife. They see Snoopy. You see The Rock with Prudential. AXA is, again, just more of a household name than you would think of American Equity or even Great American. More allocation options. Again, you've got more funds to choose from. Again, there can be some drawback there. And the guaranteed death benefit, like we were talking about earlier, you've seen a lot of FIAs exit that market. There still are some good FIAs that offer a strong guaranteed death benefit, but they've really had to draw back because oftentimes those GMDBs are lump sum benefits, so it's tough to price for. Again, on the downside, like we've been talking about, fees, fees, fees. That's the biggest thing you want to hit when you're looking at a VA. As the first thing is what's the fees inherent in that contract. M&E, administrative, and then any costs for riders, any costs for any of the different things you're going to add to the policy. Downside risk, that's another huge thing. Again, my emphasis here is change in investment philosophy. That's the big thing from a VA to an FIA is the client has changed their investment philosophy. And lastly, major change in products like we've been talking about with the lack of allocation. Prudential was highest daily 7, now it's highest daily 5, so we've seen a lot of the benefits have to be reined in, so to speak. Looking at FIAs now, principal protection, that's a big piece of why I have a job, why you probably have a job if you have FIAs, and why you are successful at selling. The principal protection piece is big. Alongside of that with annual reset. When you're looking at a VA, if you lose 10% in 1 year, the old story of I've got to make 20 just to get back to where I started the following year. Annual reset within the fixed index annuity is a big, big piece where you lock in previous year's gains, and at policy anniversary, you don't have to make up any losses that you've had in the previous year to start seeing gains. So that's a big piece. Income guarantees, again, we can match the VA and we can exceed the VA on income guarantees on any product, any case, anytime. You can show me a VA with some of the strongest benefits, and we can find a fixed index annuity that either matches that or exceeds that. And then again, to Mike's point, very low fees or asset charges. Now, there are some products within the FIA marketplace that do have fees. A lot of them do have 75 basis points to $1.25 for the income benefit. But when you compare that to the VA of 3, 4, 5%, the fees just aren't even comparable. Again, kind of the downside to the FIA is cap gains. So it's that age-old story of would I prefer a cap or would I prefer downside risk. Negative press. We've seen negative press on both sides of the equation on VAs and FIAs. I put it on FIAs because generally speaking, clients Google, Allianz or Google Aviva or straight Google fixed index annuity, and you're going to see some lawsuits or something that comes up there. And then the minimal allocation options. Some companies do offer a lot more opportunities. Aviva, as an example, is just S&P. While Allianz has NASDAQ, S&P, they've got a Euro stock. So there is minimal, but some companies do offer more than others. So that's kind of a summary page. I wanted to hammer further on the major changes to FIAs. Jeff and I have both kind of hit this here in the last couple minutes, but actuaries, due to economic factors, have required FIA carriers to change policy features. Reallocation requirements is the biggest thing. If you look down to my last example there on the page, for every 6% decrease in the asset, 5% is moved to a fixed account. That's automatically built in. You can almost think of it as a automatic rebalance or an automatic reallocation, whatever you want to say. So this is something new to the VA environment. And the downside here, or the opportunity if you're going up against the VA, is to look at the particular contract that you're up against and find out what those numbers are. So let me re-explain this. So if you're in the S&P directly, okay, let's say it's a large cap blue chip fund. If that fund goes down 6% today, 5% of that client's accumulation value is automatically rebalanced into the fixed account, never to be reinvested back into that fund.
So Jason, let me jump in there a second, guys. And we're talking facts and figures, but you have to figure out a way to communicate that to the client. So let me ask you a question. If I ask the client, would you like your investment to automatically lock in your losses? What do you think the client's going to say? Do you want your investment to automatically lock in your losses? What's your client going to say? And what Jason is explaining there is exactly what's happening, because if the account falls, they move it out of the account that could possibly move back up and get that gain back. Instead, they move it to some place that's guaranteed, which means that they're never going to be able to get that account value back up again because they've just locked in their loss. Now, with FIAs, you don't have that because you have the annual reset. So you got to think about these things in terms of how you're going to, the questions you're going to ask the client to have them tell you why the VA is not good. You should not be telling them why the VA doesn't fit their needs. They have to tell you why the VA doesn't meet their needs. Because if they can't tell you that, then they should be in a VA.
And a great story that I illustrate this point is since 2008, one of our brokers was looking at a client, and he had 30% of his overall account had moved since 2008 into this fixed account. He wanted to reallocate. He wanted to put it back into something, thought the market was going to improve, blah, blah, blah. Couldn't do it. 30% of that client's account since 2008 had been automatically swept into this, fixed account. Can't reinvest it because Mike makes a great point. You're locking in the gains, or you're locking in the losses. Excuse me. So that's a big piece of some of the changes we've seen to VAs. If you want to, and again, if you want to look at each of the particular contracts, we can do that. I put just an example of a 6% decrease into moves 5% into the fixed account to be conservative, to try to be as fair as I can. I know some of those numbers go up. The maximum they could do is 15% into the fixed account. So that's going to vary, but that's a big, big piece of today's VA marketplace. Continuing on, payout percentages. We have a piece that we created at our office that's a paycheck sales idea. If I asked you, Mike, would you rather have a 8% compounded roll-up or a 6% compounded roll-up on your income benefit? What would you say? 8. Every single time. Every single time. But what if I showed you within that same 8% payout on $100,000, if you let it defer for 10 years, blah, blah, blah. What if your payment was only $15,000, where on the 6% roll-up your payment was $20,000? What would you rather have?
Well, if I didn't mean that money, I'd go with the $20,000.
Every single time. So it's not going to be the first piece of every it's not always to look at what's better, 6 or 8, or you name the roll-up. It's going to come down to the payout percentages. Now, again, to be fair, FIA companies have had to adjust theirs as well. But you want to make sure that if the client comes back to you and says, "Hey, I'm getting a 7.2% return, or I'm getting an 8% return," while that's true, it's going to be even more important to evaluate what that payout percentage is when that client wants to withdraw the money. Because
can you explain that explain what you're talking about there?
Okay, so if you've got an index annuity or a VA, and it has an income living benefit on it, in order to get that living income benefit, you have to take a payout for life. And what's going to determine that payment for the rest of your life is a payout percentage based on how old you are. So a lot of times it's 50 to 59, it's 60 to 69, it's 70 to 79, so on and so forth. And each one of those age brackets has a payout percentage. That's almost a more important of a number than the 6 or the 8% that's the roll-up. I've got a contract that's Lincoln. It's an FIA. It's their OptiChoice 9. Only offers a 5% roll-up, but it has kickers, whether you wait 5 years of deferral or whether you wait 10 years of deferral, that totally beats the Aviva roll-up of 6.7 if you wait 10 years. That's the same way with the VA, where we did an analysis on the MET, which is an 8% roll-up, and their payout percentages from age 50 to age 75 is 4.5%. So if we can find something that not only will produce a higher payment, that's what we're looking for. Not just the roll-up, not just the highest roll-up, but also the payout percentage. And we see major changes across the board. So that's a big point. Does that make sense to everybody? If you have questions, certainly let me know at the end. Mike, does that make sense to you?
Yep.
Okay. All right. So lastly, allocation options. Can't hammer this point enough. When people are buying and selling VAs, it's growth. Again, asset funds have become a lot less aggressive than they used to be. No longer can clients allocate 100% to a small cap, high growth fund, for example. Some products don't even offer these options. Most offer a variety of bond funds and so on and so forth, where you can't get the growth or the upside that one used to be able to get within VAs. Okay, I'm going to kind of go quickly. I got about 14 minutes. This is a big piece, and what I want you to write down right now for why an FIA is investment philosophy. Or a lot of times, if you are up against the suitability department at a carrier and they are replacing a VA, the biggest reason why is change in investment philosophy. I'm going to ask you this question, Mike, and this is according to a recent study. Would you rather have a 4% guarantee without any risk, or would you rather have an 8% return with a chance of volatility or downside?
Depends on my age.
What would you
If
want
I'm
to
retired, I'll take the 4% all day long.
do? Right. Well, we asked a group of 44 to 75-year-olds. 80%, and this is 44 to 75, right in the wheelhouse for 5Q. 80% preferred a product with a 4% return and a guarantee against losing value over a product with an 8% return and vulnerability to market downturns. 80%, guys. That is your marketplace. That is your target market. And all 80%, that's a large chunk, came back and said, look, I'd rather have the 4%. That's the new rate of return. That's the new normal we're living in. Even more important, I think, is the second point here. Same group was asked to design their perfect financial product. I'm going to take a couple seconds for you guys to read those, and I want you to think of what product comes to mind. First being stable, predictable, retirement standard of living, guaranteed income stream for life, guaranteed not to lose value, protect against market downside. Hey, I don't want to think about it, stable and predictable. What does that sound like, Mike, to you?
Yeah, it's an FIA.
Right?
Yep.
So this was a big landmark study for our industry. And again, they listed like 30 features of a product. Those were the top 5 that came out of it. So it's not about getting into the differences between the two products or trying to, because you like kind of brings it back to what Mike said in the beginning. You're selling a product. When you're selling, hey, my roll-up is 8 and yours is 6 and mine is this and yours is that, you're selling a product. You want to get into the philosophy of what that client is looking for, and this is what they're looking for. Okay, I repeated it again here too because I think this was the biggest landmark finding for our industry was we want these 5 things, and that explains an FIA. All right, so if you are going to get into a battle of product feature versus product feature, what I want to leave you with is we can beat that. We can match what that VA is offering, and in a lot of cases we can exceed that. Living income benefit roll-ups are pretty much similar across the board, whether it's a VA or an FIA. Upside potential, like I've hopefully shown, is limited within the VAs with the allocation that you can put your money into. On FIAs, it's caps. So it's aggressiveness versus caps. Death benefit riders, like I say, we've got products that offer the same thing. And lastly, why pay for a feature in a VA when you can get it at a lower cost on an FIA? Generally speaking, in our country, people think if it's more expensive, it's better. Hey, that car is more expensive, that stick of gum, that house, those shoes, those pants. If it's more expensive, it's better. You could probably make the case with VAs that the feeling is the same. Hey, that thing costs more, must be better. And by cost, I mean fees. I mean M&E, I mean administrative, I mean cost of whatever. We can get you the same or better benefits at a fourth of the cost. If the average cost of a VA is 4%, And generally speaking, on an FIA, you're going to pay about 1% for that income rider. We can get you the same benefits at 25% of the cost. Why would you pay for a feature when you can get it cheaper? All right, so then which leads me into FIA.
Wait, before you go from that point. So Jason's done a fantastic job of showing us so far why an FIA would be a better solution than a VA. So Jeff, I'm going to pull you in here a second. What would your conversation be with an advisor that called you and says, "I'm trying to show, help me out, Jeff. I'm trying to show the client that a FIA is better than a VA."
I personally don't like to get into, like Jason said, a one-to-one comparison with the client.
Yes.
On one versus the other.
Well, is that person following the system, Jeff?
Yeah, no, that person's not following the system.
Okay, so
do that for you. Yeah, so that you have an understanding of it. But when I'm talking to a client, the first thing that I'm going to talk about is their VA. And I'm going to make sure that they understand it inside and out. And guess what I find out when we start talking about it inside and out? They're aware of the good things. They're aware of all the upside. Guess what they're not aware of?
All the bad stuff.
Right. And so when we start talking about disclosure issues like, were you aware, I know you're aware of some of the fees, but were you aware of these other fees? And they say no. Why do you suppose that wasn't brought up? Why didn't they bring up these other fees? Why weren't they discussed? They didn't want us to know about them. Why not? We might not have bought it if we'd known how expensive it was. Were you aware, let's forget about the fees for a second. Let's just put that on the back burner. Were you aware that this living benefit will void your death benefit? No, we weren't aware of that. What do you mean? Then they tell me it does void my death benefit. Why didn't they tell you about that? Do you think they start charging you for it once you start taking the income? No, they don't. Why not? Why did they tell you that it's gonna void your death benefit and they're gonna continue to charge you for it? No, they didn't. Why do you suppose they didn't talk about that? See, when they don't understand it inside and out and then they explain back to you the problems, do they want it anymore?
So you never get into a situation you're comparing one to another. The whole system is designed... No, yeah. Go ahead, Jeff.
I never get in a situation where I'm comparing one versus the other. I'm just getting them, ultimately what they're going to tell me is I didn't understand it. I thought I understood it, but I don't. And I'm really ticked off that the guy didn't explain it to me. I'm not working with him anymore.
That's the whole thing, guys.
Jeff, as opposed to, oh, your roll-up is 9 and his is 8. Oh, I'm going with you. I mean, it's just not.
They're never going to do that.
Yeah, right. That's not how we want to. Or let me call the carrier on behalf of the client and let the carrier hammer this for me. That's what a lot of guys want to do too.
Guys. The only person they believe is one person, and who's that person? Themselves. So I don't care if you tell them it's bad. I don't care if the actual insurance company tells them it's bad. They're not going to believe it. They have selective hearing. So what Jeff was talking about is exactly right. The system is designed to have them tell you, boy, I didn't know that it worked this way. I didn't know it did that. I didn't know it did that. My guy did this to me, so I'd buy a product I didn't want in the first place. I hate my guy. So you never get into a situation. What Jason is covering here is for your benefit, not for the client's benefit. You're never going to get in a situation where you're going to do a side-by-side comparison, a T-chart. And if you're doing that, you're not doing the system. The system is designed to have the client tell you, I don't like what I have right now, and I don't like the guy who put me in this stuff right now because he did it for his benefit, not mine. I don't want to leave. I need to leave my guy. That's what all of this is. But you need to be confident in that point before you can do this. So I just want to make a point that what Jason's doing is not so you can go in and start showing these guys all this power, showing your client PowerPoint on why what you have is better than what they have. That's what I did when I made $50,000 a year.
Right.
So go ahead, Jason.
And I think the biggest thing, and it's 5 to 10. I want to open it up for questions. The last piece of the presentation basically just went into fixed index annuities, some of the bonuses, some of the roll-ups. So guys, we can talk about that on one-on-ones. My biggest idea I want to leave you with is FIAs in today's environment, ever since 2008, really resonates well with consumers. The fact that you cannot lose value, you cannot lose a dime of your principal is really the sell here, really the opportunity, because that's what clients are looking for. We see that in study after study. And if we can give them some of the upside when things are good, built in with the income guarantees that these products offer, that's exactly what they're looking for. Again, we've seen the study after study. So with that, I can open up for any questions if we have any.
I have one question that came in and one comment. The question actually reverts back to the VA conversation, Jeff, you were just talking about. How does an insurance-only agent word that conversation in order to stay safe?
Good question.
Well, here's the the point that I was trying to make. When somebody comes in with a variable annuity, they're not always going to come in with an annuity that limits their allocation. So you guys are going to see half the VAs, probably a little bit more than half the VAs that you guys are going to see come into your office. You're going to pour through the contract and you're going to say, I don't see where it limits the allocation, and that's because it doesn't. So a lot of the VAs that you run up against will not have asset limitations. They'll be able to invest as aggressively as they want, and they'll always be able to move in and out of the fixed account. They won't necessarily lock in their losses. Now, a growing number of VAs that are coming onto the market now, and you'll start to see them more and more, do have asset limitations. The reason that they have those asset limitations is because now they're trying to compete with indexed annuities or fixed annuities that have lifetime income riders. And so VAs before didn't always offer lifetime income riders, and so when they started to come out with lifetime income riders, they had to limit the allocation. And Jason makes a good point. An FIA will always beat, or a fixed annuity, their income riders will always beat the guarantees that are available on the income side for VAs. And when you think about it, it would only make sense that they'll always be better. They'll always be less expensive, and the payouts will always be higher. Why? Well, it's the difference between what they're insuring against. See, what a VA has to insure against is losses. And they don't know what the extent of the losses in advance, so that kind of insurance is really expensive. It's really pricey. Insurance really works to spread the risk. Like when you buy car insurance, what the car insurance company is really betting on is not everybody will have an accident at the same time. Right. Because if everybody has an accident at the same time, then the insurance company is in trouble. See, with the VA company, they're in a little bit of a bind because they're trying to insure against losses, but if everybody loses money at the same time, they're in trouble. And guys, when the market drops 20%, doesn't everybody lose money? Yep. Everybody loses money. So that's really expensive. That's really pricey. That's really hard to guard against, and that's why they have to be really careful about the guarantees. When you think about the fixed side, what they're trying to protect against is mortality. Because they can't lose money. They're in a product that can't go down, so they don't have to insure against losses. What they have to insure against is mortality. Because they have to pay you as long as you live. So if everybody dies at the same time, if everybody lives to 110, the insurance company is in trouble. But how confident do you think they are that not everybody will live to 110? They're very confident that not all of us will live to 110. Some of us will, but they know that some of us won't. Mortality is something that they're very good at pricing, so they can always do it for less and make the payouts higher. You'll never find an income rider on a variable annuity that can beat the income riders that are out there for price and for payout on the fixed side because of what they inherently have to insure against. Fixed annuities can always charge less and pay more because they have a lot more confidence that not everyone will live to 110. They have a lot more confidence in the VA people that not everybody will lose money and the markets won't go down by a lot or very often. They just don't know that.
And to continue that point, Jeff, one of the big things when you ask an actuary is the difference between the account value and the income value. They get scared to death if there's a huge difference there because that means more people are going to use those income benefits and they have the price for it. Scares the daylights out of them.
And then, Missy, would you get in that comment before everybody has to start leaving here?
Yeah, and then I have another question after that as well. But the comment is, product guys always try to sell the product when these things, FIAs, must be examined in terms of a client's total portfolio. FIAs have lower volatility but lower returns historically, which fits into their low-risk, low-return portfolio portion.
Exactly. So, guys, this is not, you don't put all of the client's money into one of these. This is for their guaranteed portion of the portfolio. Though, to give be the devil's advocate here, there have been 2 different studies that have been done that shown in the last 10 years, guess what's performed better? FIAs or the average mutual fund? FIAs. So even though we keep, we're required to say, and it is true that there's caps and there's things like that, so this belongs in the lower end of the risk spectrum and the return spectrum, there are periods of time that it performs better, and it has over the last decade. And you know what? Clients have experienced what over the last decade? They've experienced a huge crash in 1999 and a huge crash in 2008. 2 huge crashes in 10 years. What did they make over the last 10 years? Diddly squat. What's going to happen over the next 10 years? If you know that, then you shouldn't be on this call. You should be on your yacht in the Bahamas with all your riches, because nobody knows that. Could it happen the exact same way again? And that's what they're worried about, because if it happens the exact same way again, what's going to happen to virtually every retired person after they've experienced this twice in the last 10 years? What's going to happen to their lifestyle over the next 10 years? And they don't, and as Jason pointed out, that study points out that they don't want to risk that. They're not worried about rates of return at this point.
Absolutely, and if you don't know what annual reset is and you're on this call, give me a call. Give me 10, 15 minutes to explain to you what annual reset is. Because why, to Mike's point of an FIA outperforming a mutual fund or what have you, the reason is because of annual reset. You don't have to make up previous years' loss to start earning again. That's why they've outperformed in mutual funds or what have you.
So as Michael said earlier about his comment about the portfolio, he's exactly right. This is not for the aggressive portion of their portfolio. This is for their median and low risk or volatility portion of their portfolio. So let me see, one more question.
Yep, the last question was, do you ever call the customer service of VAs to get the information on fees, asset allocation, riders, etc. with the prospect at the appointment?
Never. Never. That's unprofessional. That you're hoping that what you're saying is, I don't know how to frickin' sell, so I'm hoping that the insurance company will convince the person not to do it. Guys, how does the system work? The system works where you have the client tell you. Do you think the insurance company is going to have the patience to say, now, Mr. Client, can you explain this back to me? Guys, it's not the system. That's a weakling's way to do it. And guess how much money people that do that make? Lots or in the middle range? In the middle of the low range. The only reason a person's going to buy, if they decide for themselves, we've gone over, and we don't have time now, but you cannot explain to somebody why they needed something different. Their beliefs are their beliefs. You could come up, you could explain to you're blue in the face. Try to tell somebody who's a pro-lifer that they should believe in abortion. Try to somebody who believes in abortion, they should be a pro-lifer. What people believe, they believe. The only people that can change their mind is themselves. The whole system is designed so we ask questions, so the client discovers for themselves that what they have is not what they were told that they had. That what they have is not what they want. That what they have is put their advisor in a better position and them in a worse position. But I can't tell them that. The insurance company can't tell them that. Their mama can't tell them that. There's only one person that can tell them that, and that is themselves. That's how the system works. That's how guys who make $1 million a year make $1 million, and that's and calling up the insurance company and having them explain to the client is why I made $50,000 when I was making $50,000 a year. Because I thought I could argue them and prove to them and embarrass them with the facts that they have a crappy product. I won every single battle, lost every single war. The only thing that works is for the client to discover for themselves, follow our system. We began the call with why you want to follow the system for compliance purposes. But you know what? Follow the system to make a lot of money. Where in the system do you see that we should call up the insurance company and have the insurance company explain to the client why their contract's bad. Guys, do not tell, sell, preach, or teach. Let the client tell you. So add anything to that, Jeff?
No, that's exactly right. I mean, you're never going to win with the insurance company. Calling the insurance company first, you'd be surprised at how well armed those people are at explaining their product in a very positive light. And you know, if they come in there liking it and they're always going to just hear what they want to hear in the best possible light possible. Only they can change their mind. And only you can have a guided discussion with them where they explain to you why why they didn't know everything there was to know about the product.
Follow the system, guys. It'll keep you out of trouble and make you a lot of money. So, Jason, thank you very much for being on the call today. Hopefully you guys felt that this was a good thing. If you could send us positive comments if you enjoyed it, because then we can have Jason on more often if this was helpful to you, or other topics you'd like Jason to talk about. That would be terrific, too. So I appreciate everybody being on the call. Sorry we ran a little bit late, and I wish you all a fantastic week. We'll talk to you next Monday. Thanks, guys.
Thanks, guys. Appreciate it. Bye-bye.